Welcome to the expertgate interview series, where we bring you the brightest minds in business, strategy, and innovation. I'm John Lin, your host, and today I'm honored to introduce Wayne Fitzgibbon, a leader whose deep expertise spans investment strategy, risk management, and global market dynamics. With over 25 years of experience as an institutional investment consultant, CIO, award-winning portfolio manager, and a proprietary trader, Wayne's insights have not only redefined how we view economies as complex adaptive systems, but also influenced investment strategies across Australia and beyond. Wayne, thank you so much for joining with us today.
It's a pleasure, John.
Absolute pleasure. So before we dive into the discussion, can you briefly share a little bit about your professional journey and why do you do what you do?
Well, I think, like a lot of young people of my generation, I wasn't quite sure what I wanted to do at university. And I ended up doing economics instead of law. And I think as events evolved, I was very fortunate because, I finished my degree in 1982. And 3 years after my degree finished, Australia deregulated its financial markets. And all of a sudden, there was a demand for economists that had never actually been seen before. And I was working in the public sector at the Australian Treasury at the time. And within a few years of experience there, mostly in macroeconomic areas, my last role there was acting head of monetary policy section at the Australian Treasury.
Yes.
I was given the opportunity to move into the private sector. Very quickly in the private sector, I realized that if you're a very good economist, and especially if you're working on a dealing floor, as I was, and you get right, then traders make money. They make money because they're good traders. Whereas if you have a view on something or make a forecast and it's wrong, which happens more often than not, and they lose money, it's because you're a very bad economist. So it took me a few years to realize that was not a very sensible trade-off. And so I thought to myself, well, I might have an attempt at doing a bit of this trading and sitting on the other side of the table. And I think that really helped me because what I benefited from when I moved into trading was almost being able to predict what the consensus was going to say about any economic number. Now, after a while, of course, you get a bit older, you have a family, the hours become more of an issue. And I then went into portfolio management. And I started out managing multi-asset portfolios. And then one day, the firm I was working for, Macquarie Bank, their bond management team, their fixed income management team, left. Yeah. And it turned out that due to my proprietary trading experience, I was the only person in the organization that actually knew how to trade a bond. So that was rather serendipitous in terms of my career. And, I had a very successful career at Macquarie Bank and ended up being CEO of fixed income, currency, and also commodities. And then as I got older, and as one does, I retired. And then after a couple of years of retiring, I decided I needed to do something, and I ended up going to Mercer as a senior investment consultant. And before I retired again in 2022, I had spent a couple of years as the head of investment consulting at Mercer UK. So that's my short summary of my career.
Oh, well, thank you, Wayne, for going through your journey. And it's been certainly a very colorful journey with various serendipitous moments, as you put it. Now, I'd like to ask, how has your experiences shaped your perspective on economics over the years?
Well, I think the main thing is that, whichever way you cut it, both microeconomics and unfortunately the current orthodoxy in macroeconomics, is based on two things. It's based on an assumption of general equilibrium, and it's also based on the assumption that we're somehow optimizing something. Whether that's utility, which is this nebulous concept that has been debated for the best part of 300 years, or whatever. And I think if you think, as I do now, of economies and markets as complex adaptive systems, it's a messy world out there. Everything is connected to everything else. And I often say this to people, in economics, and particularly finance, you're taught that markets are supposed to reflect economic fundamentals, whereas in reality, they co-determine them. They are one integrated system, and that's what complexity theory tells you. It also tells you that macroeconomic outcomes are driven by compositional effects. The bottom up matters. And in particular, the essence of complex systems is the role played by collective behavior. And we see this in nature everywhere. But when it comes to human beings, we know that we herd, we're tribal, we do all these things that people are not supposed to do. And if you look at markets as a human creation, which is what they are, no other species on the planet engages in market activity. It's a specifically human activity. And I think when you take that perspective, you take a much more bottom-up view of what is happening in the world. And the best example I can give is the orthodox theories of inflation, which is obviously very topical at the moment, are partly relevant, but not the entire picture. Because at the end of the day, inflation is an emergent phenomenon. It comes as a result of the collective behavior, and not just of, as we frequently hear, wage increases being, or workers demanding wage increases. It's also about the pricing behavior of firms. And of course, economics, if you adopt the traditional microeconomic assumptions of perfect markets, there is perfect competition. They have no pricing power. And somehow the models were modified to say that unions have pricing power. But if you think about the history of inflation, inflation was low because of globalization, opening up of massive workforces in Eastern Europe and then China, highly educated workforces, and producing things at much lower cost. And so there was this massive disinflationary effect on the world economy for the best part of 20 years, first with Eastern Europe, then with China. And it led to an amazing growth in prosperity for everybody and very low inflation that no one can actually explain. But also we had the internet. And so what did the internet do? It allowed greater price discovery. So early in the years of the internet, if your costs were falling, no one with any market power running a business would dare to put up their price for fear, unless they knew their competitors were going to do it, for fear of losing market share. So there was this almost fear of both price discovery with the internet and also ever falling costs globally. And it's no wonder that inflation was low. And I said to my clients in the UK a couple of years ago, inflation is going to come back eventually. And I actually wrote a paper on it at Mercer. And the simple logic was, well, we've moved from globalization to, if at best, regionalization. And the massive impact of globalization in perpetually reducing costs of everything had stopped. And then we have these things, particularly climate change, which is going to affect the price, particularly of foodstuffs and various other things, and coupled with firms rediscovering that they've got pricing power. So again, there is an expectations element to inflation, but it's collective expectations. And I think that's what everyone's missing. And I think that's why, I've been saying for some time now that inflation is going to be sticky. Yes, it's come down, but it's not coming back to 1%, not anytime soon, because there's too many upward pressures on it. And of course, the chaos that's been unleashed in the global move away from, well, I'm not sure what you would call it, but the politics of ideology that we've lived through, where nations cooperated, the post-war institutions of global cooperation represented in things like the United Nations have clearly given way to probably, if you look at history, the more dominant political culture of realpolitik. as it was dubbed back in the days of Bismarck. So, we're back in the world of real politics, and we're seeing that every day. And so the world is going to be very different, and it's probably going to have a higher structural level of inflation. Now, I don't know what that number is going to be. It might be four, it might be 3.5 to 4.5. I don't know what that number is going to be, but it's certainly not going to be below 2 or hovering around 1 or 0. So that's I think, an example of where orthodox theory is not coping with what's happening in the world, and which is why you're seeing more and more stories saying that orthodox economists have lost the faith of politicians. I'm not surprised.
Oh, very well put. I mean, it's certainly our days gone of the times of that 1% inflation with as you mentioned, the price discovery of the internet and this kind of shared fear among all the players involved of trying to increase their prices and being not as competitive as attractive in the market, right? But I'd like to get a bit more on your perspective, Wayne. That so that this is the world that we're going to be in now, right? How would you say then, as a fund manager, right? Or you are maybe you are trying to get into the game, or you're already a fund manager and you're looking to take the next level, right? How would these kind of perspectives and this kind of knowledge and this viewpoint be able to have a positive impact, or you can utilize this in your strategies as a fund manager?
Well, I think it depends. There are a vast array of strategies and a vast array of asset classes, and they seem to be multiplying. We have had an astonishing degree of strategy and asset class proliferation in my career. I think that the biggest challenge facing anyone wanting to manage money on behalf of others is to have a very clear strategy and a very clear niche that they're looking. Now, niche sounds, that doesn't mean you can't be a generalist manager. I mean, I don't consider fixed income management or equity management as niche. Niche management is more in the hedge fund space, where you have very narrow strategies that can actually work for a time. And I think that the best advice I'd give any fund manager is clarity. And I think one of the other, and maybe this is just my personal bias, most managers, when they are talking to clients, start out by selling the asset class.
Okay.
I'm kind of strange, because usually people who are looking to hire a fund manager are usually institutional investors, maybe retail investors who are just buying something that says it's an equity product or a bond product or an ETF, and they just like the name of it or something like that. But if you're looking at the institutional space, they already know something about the asset class.
Yeah.
So there's far too much of people selling asset classes rather than what makes them different. I think what makes you different, what it is you're doing differently, is what people buy. Now, that comes from my experience, essentially as a fund manager, where there was a narrow number of strategies that the firm I worked for offered, to seeing many, many managers across all the strategies. And the best advice I've always given people is don't sell the asset class. The clients already decide to buy the asset class. What they actually want is what you're going to do different. How are you going to fit in their portfolio? And I think that is a critical piece of advice. The other piece of advice I would always give fund managers is don't turn up with an 80-slide deck. PowerPoint is not Word. If you've got an 80-page document that you want to leave behind, that's fine, but please don't turn up with an 80-page deck. You should be able to do it in 5.
Yeah, Wayne. Look, I think that that notion and that's mirrored across all industries with the 80 page deck, but certainly very well put. Simplicity and to the point is often is missed out a lot in today's world. And also when you were talking about what's really important, it's about the whole piece on why you are doing what you're doing and how that can solve the problems of your client,
Well,
right?
I think if we're talking about multi-asset investing, and
Yeah,
in my current role at the Portfolio Construction Forum,
yeah,
most of the people at the forum are multi-asset, multi-manager investors. So obviously, my experience of looking at managers and being a manager, but also having managed multi-asset portfolios, even though most of my expertise is in bonds and currencies, it gives you insights on what they should be looking at, and I think probably in the bigger picture thing,
mm,
we continually read about the 60/40 portfolio. Um,
mm,
and we see endless analysis of the 60/40 portfolio, how changing equity and bond correlations, moving all over the place. No, it's not always negative, so therefore bonds are not always a risk reduction or a risk reducing asset.
mm,
Um, I think a lot of that stuff is because the current orthodoxy of thinking about diversification across multiple asset classes. If you get diversification benefits, it's good. Diversification is a so-called free lunch, which to some extent is true. But
mm.
when you take a complexity perspective on the world, you become much more fearful of over diversification, over specialization, too much complexity in a portfolio, because the more complex the portfolio, the harder it is to work out what the actual correlations are. And
Mm-hmm.
history is rarely a guide because, in a complex system, the structure of the economy, the structure of markets is not the same as it was 10 years ago or even 5 years ago, let alone 20 or 30. So doing analysis over 20 years or 30 years and saying the correlation's this and the whatever, it's largely irrelevant. And I think one of the other aspects, and this is very important at the risk of getting technical, a lot of the analysis that is done in portfolio construction forgets two very important things. The most important thing is stationarity. If you are analyzing data, you have to be confident that the data generating process is constant. That comes back to the whole discussion we had earlier about equilibrium. And if you take a complexity view of the world, you know that the data generating process is not the same. It evolves like
Yes,
we do as a species,
yes,
as nature does. So it's always evolving. So history is a guide because markets are human.
mm,
And oddly enough, we have some pretty innate traits that no amount of education and civilization has managed to alleviate. We have lots of flaws. We are not perfect beings. And so, because we're not perfect beings, because markets are full of people, we change and markets
mm,
change. And so, you really have to think long and hard about the sort of environment you're in before you start, just looking at historic numbers. Historic numbers are really very useful. And I think if people take a critical eye to most of the analysis in markets, you will see that. But I think even more importantly, volatility is not risk. Volatility is risk is if you always stay invested and no one ever goes broke, or everyone's got in theoretical terms, the assumption in economics and finance is people all have the same endowments. In other words, the same pot of money that you start with. And that's obviously not true.
yeah,
And also that they never have to dip into it. In other words, they never have to leave the game. And they're the only circumstances under which volatility is actually risk. And so risk is loss of capital. And I think increasingly high net worth individuals, and I think increasingly pension funds are starting to realize that. Because with aging populations in the developed world,
yeah,
people are having to draw down money. And, relying on some 20-year correlation in a portfolio when you know that you've actually got to take some money out is a recipe for disaster.
mhm,
There needs to be much greater focus in portfolio construction than instead of simply 60/40. You need to focus on generating income and capital preservation. And that, I think, is probably the best advice I would give anyone in terms of strategy over the next decade or so. Maybe not over the next year or the
mhm.
2. because I suspect we might have a high degree of uncertainty and volatility in this new realpolitik environment that we've entered, which is not going back. There's no mean reversion in what's happening in geopolitics. It's just a new era that we'll find out about as times goes by. But certainly, I've been saying to people, if you're taking even a 5 to 10 year view, you've got to start thinking about preserving capital, because my generation as I'm sure you know, my generation are the luckiest generation in history. The baby boomers, biggest demographic event since the Black Death in the 14th century. And when we get old and populations start declining, finding growth assets to give you growth is going to be a bit harder, because it's easy to get growth when you've got growing population. And aging populations and declining population growth, at least in the developed world, is going to be a real challenge for investors. And if we, the baby boomers, don't preserve our wealth, because we've only got paper wealth, it's invested wealth, but it's not, if you like, cash wealth. It's subject to asset price movements. If we lose that, what are we going to leave for our indebted children? Because our children have debt, and we have, and that transfer of wealth from the baby boomers to their children, indeed, hopefully their grandchildren, is, I think, one of the biggest issues that no one really talks about.
That is certainly a very insightful take. Admittedly, it's something that I haven't actually considered. And you mentioned earlier the realpolitik era. Look, Wayne, I completely agree with you. Once it's left, you've opened the Pandora's box. It's out now. There's no going back anymore. No, it's definitely not.
I think on the realpolitik, I think the important thing is that I have to admit, I try not to let my political views get in the way, but I'm a centrist. But I think the real issue in politics is that you have to accept what's going on. You have to understand the secular nature of what's happening, and what's happened before. And you also need to study a bit of history and realize that the sort of environment that, again, the baby boom generation has enjoyed is rare in human history.
Yeah.
I think that's something that needs to be recognized. I think also the other thing that needs to be recognized is that human history is going to be changing due to technology. Now, I'm not a big fan of large language models at the moment, because I find them quite annoying. But that's probably just my generation. But the advances that AI can provide for medicine and science and various other things, and the recent announcement by Microsoft of their breakthrough in quantum computing changed the world. And of course, the one thing that no one talks about, well, some people do, but it sort of fades. It's faded into the background with all this focus on AI, maybe because most of the AI expenditure is being undertaken by, the major tech firms, where advertising and more targeted advertising seems to be the current priority. Whereas the reality, quantum computing will change everything about our world, including, dare I say, economics and markets. But also, fusion power is the great revolution that's awaiting us, and the ratio, the ratio is improving in terms of how much heat does it take to generate how much power, and one day someone will crack it, maybe with the benefit of a quantum computer. But they're the really positive things that lie ahead of us. So I don't want to be overly negative, but also those advances in an era of realpolitik will be very different than if they occurred in an era that we've been in, with global cooperation and multilateralism as a broad global political philosophy.
So when you said the times are changing, and things are going to be very different. So now, as you know, we are transitioning into Industry 5.0, right?
Yes.
And technology is a center part of this, right? It's going to reshape every aspect of business. You mentioned quantum computing, fusion power, and also with AI. Understandably, the way that we are looking and using AI is it's different. It's case by case. But how do you envision this kind of revolution, right, impacting the future of finance, and particularly in preparing professionals, right, for this AI-driven, human-centered world?
Well, I think that, it's almost an impossible question to answer. I don't know. But I think I'm always been an optimist. I mean, I think the world can be a much better place.
Yes.
I think the challenge is bringing everyone along. When the current revolution is being driven by a handful of near monopolies with massive global power, something like we saw with DeepSeek is actually refreshing, because the only reason we're sitting here talking here over the internet is that someone decided to make it open source code, and everyone could. It was a gift to the world. I'm not yet convinced that the benefits of AI will be a gift to the world, but they might be. But I think things like fusion power, I also think from an economic point of view and from a wealth point of view, I've already said that wealth preservation now has to be a priority for most people with significant wealth, not growing it, because it's almost like exposing yourself to losing it. Because growth cannot continue at the rate it's been at. And if the benefits of productivity, which will be huge, and indeed have been huge from the internet, even though it's not evident in economic statistics, the benefits of these new technologies will be immense for human beings. But we also need to change economics to see the world as something bigger than the efficient allocation of resources. It's about the quality of life of our species. And more importantly, sharing the quality of life that we share in the rich developed world with the rest of the people on the planet. And I think the opportunity of the fifth industrial revolution might be to finally benefit most of the people on the planet rather than subsets or just a few. But perhaps I'm too much of an optimist, John.
well, maybe perhaps that might be the case, but it's good that we are having these kind of conversations, right? Because at the end of the day, moving forward, profit can't just be the end all and be all, right? And it needs to be this kind of quality of life and increasing quality of life, that it needs to be spread globally, so that because we're all in it together, whether we like it, right?
And again, just the one thing I would say in closing on this is that, the way I see AI at the moment, and I've had hands-on experience with AI in my previous role in terms of doing research reports and things like that, which is, becoming very common in the financial markets. I've heard people say that there are no stock analysts left on Wall Street, apart from a handful, because they're all being replaced by computers analyzing company accounts in a nanosecond. And there's going to be a section of current white collar, to use the very old term for it, white collar workers who may not have a job. And the challenge of that is there's got to be a rethink about how our societies are structured, because oddly enough, bots don't buy cars, houses, go out to dinner, and they don't need clothes. So in a sense, the AI revolution could actually underpin the market it's trying to make money out of.
Yeah, that's certainly a very frightening.
Well, I'm an optimist. but I think that is a perspective that's not being taken.
Yeah.
The massive investments that are being made in AI, which is Wall Street's getting very nervous about whether it's going to be paid back. I mean, I refuse to pay $1.99 a month on my Amazon Prime account to get the ads taken away. I just refuse to do it. I feel like they're using their market power to force me to pay more. I think there'll be a fair bit of resistance to paying. I recently, there was a story about Microsoft, for Copilot and their new software packages. They're upping the price by 20 or 30 US dollars or something rather, and people are going, well, I don't want it. So I think there's an element that a lot of the investment in AI may not actually end up being as profitable as people think. But again, it still in the long run is going to lead. Some people say it'll create jobs. It might create jobs, but I think there is a risk that it will destroy more jobs than it will create, and that will become a problem both politically and economically globally.
Oh, touching upon that point, it certainly does run that risk of eventually having the AI overlords take over. But Wayne, we've certainly gone through all types of different topics and your perspectives on economics and technology, from quantum computing to AI to fusion power. Now, at expertgate, you have this opportunity to collaborate on groundbreaking projects, right? Now, for yourself, Wayne, what types of initiatives or partnerships are you most excited about in exploring?
Well, I think in terms of my expertise, I think where I can help is in thinking very differently about how you put portfolios together. Because the dominant thinking you can pick up, and particularly in academia, right? I think, I think in many disciplines, particularly in my areas of expertise, economics and finance, there has been little progress in how people think. There's been, things done at the edges. I like to use the analogy of medieval astronomers who kept observing that it seemed like the Earth revolved around the sun, but for fear of being burnt at the stake for heresy, they came up with ever more convoluted theories and fiddles to their theories to ensure that actually, no, despite what their observations said, the sun actually revolved around the Earth. And I think a lot of academic finance and economics has fallen into that trap. And that will only change when the current senior academics globally move on, because a lot of people who see the flaws in that academically. So I think where I can add value is by some of the people who a generation or so younger than I am, have been taught a lot of things that are simply not right. Various credentials offered globally have entrenched those ideas into them, because a lot of them are more rote learning than in my day, when university was a place that taught you to think. It about learning everything that you had to pass an exam. And I think the culture of education has changed. So I think where I can help people is to see the world from a different lens. And as I said, realize that portfolio optimization, you can optimize portfolios, but you've got to optimize them using different mathematics and different measures of risk and return. And that's where I think the complexity revolution is going to make a difference, even though it's been going on for 20 years. If you think about it, the current orthodoxy in economics was born in the 50s and 60s and only really emerged in the political sphere in the late 70s and 80s. So it does take a long time for new thinking to emerge. And I think that where I can add value to projects, whatever they may be, certainly something related to investments and portfolio construction, or indeed economic thinking, I think I can add value to people in those spheres by guiding them through This revolution that started, more than 30 years ago, will eventually become the orthodoxy. And dare I say, especially if in 10 years we have something that is workable to apply to finance and economics, from quantum computing.
Well, Wayne, there's certainly this lag in theory and information and taught in academia and whatnot. And I believe that your insights, particular insights, very in touch in the real world perspective of things, will be certainly invaluable to this next generation. And look, Wayne, I really love how you've broken down these complex ideas. It makes them very accessible for everyone. Now, before we wrap up, right? I'm going to put you on the spot, Wayne. If there was one last piece of advice that you would give to the aspiring next generation, right, in your field, what would it be?
I think the greatest failure in sort of economic and finance education these days is no one reads enough history of thought. You asked me earlier about the books on my bookcase, and I can tell you they are my favorites, and there's a lot of history of thinking about economies and markets that are simply not taught. And I think I've always been, my hobby has always been history, even if my role has been very different to that. And I think while history, as I've already said, never repeats, it tells you about humanity and how institutions and politics and all those sorts of things have evolved. And again, while it never repeats, it rhymes simply because we're still human beings with all the flaws and shortcomings that entails. We have been killing each other since the dawn of time, and we still find ways and reasons to do it. We are who we are, and I think reading history makes you understand things like happening now, which for most people is like it's almost like, oh, that can't be happening. It's not going to happen. No, this isn't. The president of the United States is not going to turn around and say Russia did not invade Ukraine. I mean, but if you look back through history, you will see that what is happening now has happened before.
Certainly, very, very well put, Wayne. That is something that a lot of us really does need to learn, right? The reason that history repeats itself is because we are who we are.
Correct.
Well, Wayne, thank you so much for sharing your insights and for a truly engaging conversation. Your expertise in investment strategy and risk management not only illuminates the complexities of global markets, but also offers a roadmap for navigating today's and perhaps in the future's financial landscape. To our viewers, if you're eager to learn more about Wayne Fitzgibbon's work and explore how ExpertGate is connecting the best minds in the industry, please visit expertgate.org. This has been ExpertGate for everyone